All right, from the very beginning, Minsky had an endogenous money view. There have been some post-Keynesians who try to argue that he didn't. In my view, they are plain wrong. You can go back and read his earliest stuff, and you will see he had an endogenous money view. He always said, anyone can, he didn't always say this, sorry. Later on, he always said this. Anyone can create money, the problem is to get it accepted. Okay? That's about as endogenous as you can be. Anybody can create money. You have to get it accepted, that's the hard part. He started with the view that money is primarily a unit of account. It's the account in which we denominate our IOUs. In case you don't know, in English, IOU is just a debt. It's a liability. And these are always denominated in money terms. Banks are firms. Okay, so Minsky always started with it. Banks are profit-seeking firms like any other firm. And they innovate to get profits. So he was following what his dissertation advisor Schumpeter said. You know, you have to look at firms as innovative profit seekers. All Minsky did was use the same view and apply it to the financial system itself. So they're seeking profits, they're always innovating. The central bank supervises them, it regulates them, and it sets an interest rate target. All right? And then the central bank and the bank play a game. The bank sets a rule, the banks try to find a way around. Okay? And the regulators have to understand that this is what banks are always going to do. So you always have to change your rules, adapt them to take account of all the innovations. All right, here are some quotes from Minsky. A bank is not a money lender that first acquires and then places funds. In other words, banks don't sit there and take in deposits and then lend them out. That's not what they do. That's what a money lender does. Minsky used to always joke, if you want to see a money lender, you go to the street corner in Chicago where there's a guy standing there in a trench coat, and he actually has cash he will lend to you. He lends it at 300% interest, and if you don't pay, he breaks your legs. That's a money lender. He says banks are not money lenders, that's not what they do. They have no cash. What they do is they lend their own IOU. Okay? When they lend their own IOU, they create deposits. So they create the money they lend. They don't take in money and lend it out, they create it. A bank first lends or invests, then finds the cash, it means reserves, to cover whatever cash drains arise, either through clearing with other banks or at the ATM machine. Banks make loans, and then they borrow reserves to cover any withdrawals. It cannot be assumed that the amount and rate of change of reserve money, so this is the reserves supplied by the central bank, is either exogenously determined or the result of a policy decision. So reserves are not exogenously determined by the central banks. They're determined by the needs of the financial system. Central banks accommodate the demand for reserves. Any economic unit can emit liabilities. The only problem is to secure generally accepted. So again, you have to get your liabilities accepted. That's the hard part. So what's the Minskian view of banking? Banks create money by lending their own IOUs. Extending loans creates deposits. Banks are not primarily intermediaries. They don't just move savings around. They don't take your deposit to savings and lend your savings out. That's not a banking operation. Banks do create liquidity. Okay, they take your IOU, which is not very liquid, and give you their IOU, which is very liquid. So they've created liquidity. But that liquidity creation is highly endogenous. In good times, there's plenty of liquidity. Financial system creates it. In bad times, they will not and maybe cannot create it. Only the central bank can create it in bad times. So it grows and booms, and suddenly it disappears in bust. In 2007, liquidity suddenly disappeared. Didn't exist anymore. In 2006, there was an infinite amount of liquidity. In 2007, there was none. Disappeared overnight. Bank credit can be highly destabilizing, so you can think of it as being pro-cyclical accelerator of the economy. It accelerates the boom, and it disappears and accelerates the crash. And that's the core of the instability theory. Here's a